Welcome to the Lend Academy podcast, session number 8. This edition of the podcast was recorded on my trip to London last week, where I went to speak at the LAP08 conference, and being on the road, I didn't have my usual recording gear, so this audio is not quite the same quality as what you've been used to, but I think the editor has done a great job, and you can certainly still hear it. So at the LAP08 conference, as I said in my blog post, my favorite session of the day was from Cormac Leach, who is an analyst at Liberum Capital. And he had a fascinating presentation talking about not just the UK P2P lending industry, but the industry globally and specifically also here in the US. So I sat down with Cormac and his team at Liberum in their offices last week and did this on the record interview. Hope you enjoy it. Okay, so I'm here in the Liberum offices in London with Cormac Leach and Karen Lucy. Welcome to the podcast.
Hi.
Hi, how are you?
Okay. So I want to get started off and obviously want to get some background on Liberum. Not everyone's heard of your organization. So if you could just tell me, what it is you guys do.
Sure. So we're an independent stockbroker, helping companies raise money and providing independent research on a whole range, 18 sectors right across the UK and Europe. And we've raised £11 billion for various companies over the years. And we have quite a large financial team. We have 4 professionals looking at a whole range of finance companies, including banks, and recently become really interested in peer-to-peer.
Okay. And how many people do you have working in your organization?
I don't even know. It keeps growing, actually. What do we have? About 150?
160 at the moment.
160.
Okay, so you're a decent size. That's and so Cormac, are you actually dedicated to P2P lending, or this is part of what you cover?
In theory, this is just part of what I cover, but in practice over the last 3 or 6 months, we've been full on, 90% of our time has been looking at this sector, actually.
Okay. And what about you, Karen? Are you the same?
I'm pretty much dedicated to peer-to-peer at the moment as well, but then I work under Cormac, so doing bits of other things as well.
I would say almost 100% of Karen's time has been focused on this. We're also doing quite a bit of corporate finance and peer-to-peer as well. So between the corporate finance and covering Trust Buddy, I think Karen's been flat out on peer-to-peer.
Right. So is your focus on the UK, continental Europe, globally? Where's your focus?
Yeah, so we operate in the UK, and so most of our actual revenue generating business is in the UK. But to understand the bigger sectors, we've been looking very much at what's going on in the US, because the US is ahead of Europe to a large extent in terms of what the key drivers are. And for example, Lending Club is clearly the elephant in the room, 2/3 of volumes in the space,
right,
excluding China, of course.
Right.
So we really need to, pay close attention to what's happening in the US.
Okay. So have you put together actual deals in this space for raising money? I mean, what's some of the things you've done?
We've done several things, actually. So last year, 2013, we founded and sold a business which aims at setting up a relatively large, perhaps £200 million closed-end fund looking to raise permanent capital to lend onto peer-to-peer platforms, and also takes, strategic equity stakes in peer-to-peer platforms. So we founded and sold that business to Marshall Wace, and that was, I think, at the end of October. And then after that, we worked very closely with a Swedish listed company called Trust Buddy. We raised 15 million euros for them. And then in January this year, Jan 14, we raised 15 million pounds for Zopa as a private placement.
Okay. That's good.
And it's worth saying, actually, we're working closely with several platforms currently looking to, put in some equity, and also looking for other flavors of capital, frankly, mezzanine, quasi-equity, underwriting capital, and also some permanent wholesale term debt to lend on the platforms. So I would say we're quite actively looking at, connecting investors with the space.
Okay, great. So I know that you gave a presentation earlier this week on at the LAP08 conference, which I found personally fascinating, and it's going to be in the show notes for everybody listening on Lend Academy's website. And I recommend everybody spend some time and go through this presentation. It's excellent. One of the things that I found personally most fascinating about your presentation was this idea about efficiency gains in banking, or the lack thereof. And I mean, every industry
I can't think of another industry that hasn't had massive efficiency gains over the last 100 years because of all the automation and all the technology. But you're claiming that this is simply not true in banking. So can you explain, one, how you kind of came up with that idea, and then any of the numbers behind it?
Sure. So, well, first of all, I'm a banks analyst, right? So I've been spending, the best part of the last decade looking at banks. And, if you spend any time looking at banks, you get a feel for how efficient they are. And, the one thing jumps out as an analyst is there's a lot of scope for them to rip costs out, in terms of, whether it's overpaid fixed income traders or, it's too many branch staff, or, if you actually go in physically to a branch, you just see there are far too many people in the room, and the technology feels like, it's from the 1970s at best. Mm-hmm. We also have, quite a lot of examples where the IT has simply failed in the UK. RBS ATMs just simply not working, for example. So you don't need to be a genius to figure out that the IT the banks are working with is not state of the art. And then, there's a whole body of academic research that suggests that, the banks are not efficient. We leaned quite a bit on a chap called Thomas Philippon from the NYU University. He's a professor there. He's published some really good research in my view, and he's leaned on the likes of Schiller and Bernanke and a whole range of top-notch academics to produce this analysis looking over 100 years at the relative efficiency, the unit cost of financial intermediation. So looking at the costs, or the revenues, if you like, the net revenues of the banking system as a percentage of the intermediated assets. And
so hang on, what do you mean by intermediated assets? Just explain that.
So that just means that, you have a large pool of money. So you have a large pool of people who have money to invest, and then you have a large pool of people who need money. And then simply connecting those two pools of money, that's intermediation.
Okay.
So, and that's to a large extent what the financial services sector is doing. I think they've kind of forgotten that that's what they're doing. They kind of think they're there to line their own pockets. But in principle, they're there to connect those two pools of capital. And, naturally, Darwinian competition should force that process to happen as efficiently as possible. And it's my view, actually, because the current structure of the financial system is inefficient, because you have a relatively small number of oligopolistic players who are heavily regulated and therefore heavily, to some extent, subsidized by the government. So you don't have the forces of competition unleashed on the sector, keeping everybody honest and driving innovation and driving efficiency. Where, for example, you do in technology, or you do in retail trade, you do in wholesale trade. And I think it's really about the financial plumbing. So if you think very simplistically, we have several huge pipes, and systemically we can't afford to have anything happen to these pipes, so they're overly protected. And you don't have the extreme competition that you should have. And in my view, peer-to-peer brings that competition into the space, so it's extremely healthy for everybody.
So even with, I know, like in the UK, there's 5 big banks, but the US has, there's 4 big banks, and then there's, dozens of pretty big banks, and then hundreds or thousands of medium to small banks. So even with all that competition, you're still saying that this is an inefficient market still, and not really any more efficient than it was 100 years ago.
Yeah, I would make a couple of points there. One is that because everybody's been gearing up, if you look at the ratios of private debt to GDP, or corporate debt to GDP, or government debt to GDP, debt to GDP ratios have been rising. So everybody feels like they're getting richer. So there hasn't been that kind of price sensitivity or that cost consciousness that you should have in the space, because everyone's seeing, their house going up in value, whatever it is, 5 or 10% per annum. So they're not that price sensitive in terms of the cost of the mortgage. That's one point to make. The other is that everyone has access to the lender of last resort, the Federal Reserve. So to a large extent, you have a subsidized system. And also it's heavily regulated. So the barriers to entry are reasonably large, and you know better than me, but my understanding is that in terms of maximum number of deposits any one bank can have in a particular region, it's quite heavily controlled, so that you don't have, the forces of competition as strong as they should be, in my view.
Right. Okay. That's fair enough. So another slide that you had that I'm just going to go, actually, for people who are following along, if you're in front of a computer, go open up the slide deck, because that was slide number 7, and I'm actually going through some of these slides here, which I think are very, very interesting. Because the other thing I wanted to talk about, is switching gears, you made the point about peer-to-peer lending being competitive in a high or a low interest rate environment. I'm on slide 11 of this presentation. So, and you've got a chart here that shows, basically peer-to-peer, the benefit to borrowers, the benefit to lenders is still going to maintain when we have a more, let's say, a traditional interest rate environment where rates are not close to zero, they're up around 4 or 5%. So can you explain your rationale behind that thinking?
Sure. So when we were going around, kind of telling everyone how fantastic peer-to-peer was, one of the kind of criticisms that we kept coming across was, peer-to-peer is doing very well right now because interest rates are very low. When interest rates normalize, and obviously another question when they will normalize, but when they normalize, the peer-to-peer will be less attractive. So we fundamentally disagree with that, because the key point to make is that peer-to-peer is about twice as efficient as banking in terms of intermediating savers and borrowers. So the key thing to look at for a bank is the gap between the rate at which people are borrowing and the rate at which they can invest, the rate that they can get on a term deposit. And for banks in the UK, it's about 4% currently between the rate at which a consumer can borrow and a term deposit rate. So that's 4%. For peer-to-peer, the cost of intermediation, when you combine the cost of the lender and the borrower, comes to about 2%. And so as rates go up, all those rates move in lockstep. So the relative gap for a person using a bank either on the borrowing or lending side relative to peer-to-peer, everything moves together. So peer-to-peer stays as competitive in a high rate environment as it is currently.
So you're saying when rates go to 5%, that 4% difference is going to maintain whatever.
Exactly. All the rates move more or less linearly so that the relative competitiveness of peer-to-peer persists.
Interesting. Okay. So then let's talk about taxes and the impact. I mean, we were just talking with Giles at Zopa, and he was explaining about the UK investor has a disadvantage because they pay interest on the tax, and then but you can't deduct the losses.
Correct. The losses are not offsettable against
which is not the case in the US. Firstly, when you talked about ISAs, can you explain what an ISA is?
Sure. So we had a vague idea what they were, but just had a meeting. You actually checked exactly what they are. So it's an individual savings account, and currently, anybody living resident in the UK can put about £11,000 into one of these accounts, and essentially it means that all of the earnings you make from securities that you put into that investment account, be they bonds, equities, what have you, they're all tax-free. Mm-hmm. As it currently stands, you can't put a peer-to-peer loan into your ISA.
Right.
Which means that if you, for example, were to put some money onto the Zopa platform, if you're lending on the Zopa platform, you have to pay tax on the gains. And the problem with that is that, Zopa is a good example, for example, because they are very low risk, very high quality loans. But, the flip side of that is that the gross yields you're getting are less, there's something lower. So, if you take a worked example, we like to look at a high rate taxpayer in the UK who has a marginal tax rate of 45%. If he puts his money onto the Zopa platform, he's getting a net yield, an expected net yield of about 4.6%. But then he has to pay tax on that. So his effective after tax return is 2.5%. However, if he was to instead put his money into a cash ISA, he'd be getting 2.8%. So as the regulation currently stands, it's more logical for him to put his money into a cash ISA.
Right.
Now, when the regulation changes, and we expect peer-to-peer loans to become ISAable in the UK in the second half of this year, second half of 2014, at which point, if the guy in our example were to put his money into Zopa loans, instead of getting 2.5%, he's getting 4.6%. Right. 4.6 clearly much more attractive than 2.8. And therefore, we think you could see a surge in volumes in the UK. And, we did some analysis, and it wasn't particularly sophisticated. We said, what would happen if the peer-to-peer asset class was to attract 10% of the total money in cash and equity ISAs? And the total amount in cash and equity ISAs currently is about £440 billion. So if they took 10% of that, 44 billion, that's equivalent to about a 50-fold increase in terms of the size of peer-to-peer balances in the UK. So, that would be fantastic for Zopa and the other peer-to-peer platforms.
So this regulation is definitely coming, or is it probably coming? What are your... because that's huge, because in the US we've had ISA is an IRA, and we're allowed to put in $5,500 a year, I think, right now, and that it slowly increases and if you're 50 or over, you get to have an extra $1,000, but you can put anything in there pretty much. Well, not anything, but you can certainly put P2P loans. And we find that I don't have the numbers off the top of my head, but there's a huge chunk of assets in Lending Club and Prosper coming in through IRAs. So I would say the same thing's going to happen over here. Yeah,
I would agree. I mean, I think it's very high probability that we do see peer-to-peer become ISAble, if not in the second half of this year, then almost certainly early next year. And there are quite a few indications that we may actually get an announcement in the budget. So we get a budget in the UK in April,
right?
And we expect that they almost certainly will. We know for a fact that peer-to-peer will become regulated by the FCA. That's the Financial Conduct Authority in the UK, and they're going to regulate the peer-to-peer platforms in the UK starting from next month, and then. Once they become regulated, it's much easier to see them becoming ISAble, and the government officially promoting them as a legitimate investment asset class. And there's some technical issues that they need to work out in terms of exactly how the mechanics will work. But we expect they will announce that they will become ISAble, and then there will be a lead-in period of perhaps 3 or 6 months, which will allow everybody to prepare to make this stuff ISAble. Right. And I know, for example, Zopa is looking at potentially setting up a fund themselves, so that people can actually, invest in that fund, and they simply need to notify the government that, they have ISA money in this fund, so that, to prevent people from putting money into the ISA with Zopa and also claiming an ISA with someone else.
Right. Sure. No, I can see that, that's going to be huge, because not only does it give people a tax benefit, but it also puts another stamp of approval. So you got the regulation that's coming, which gives a certain level of approval for the industry, and then that would be, I can totally see how that's just going to really drive it.
The other point to make is that the Bank of England and the UK government, they're very keen to promote peer-to-peer because they see it as an additional credit channel. I'm guessing your listeners will be very much aware that UK and European banks are deleveraging. So the banks are under pressure to build up their capital ratios, and they have less capital than they used to have to make credit available to the economy. So the extent that peer-to-peer can step in and supplement some of that lack of credit provision, that's very helpful for the government, and the central bank is quite keen to promote it actually. So it's quite useful to have the authorities and the regulator actually actively promoting your sector.
Yeah, I know. And then you've got the whole thing about the British Business Bank, which is. They've given peer-to-peer lending. They're obviously on Funding Circle, and then as Giles was saying, they're actually lending on Zopa as well.
I think they put 10 million onto Zopa.
Yeah, that's 75 million they've invested in peer-to-peer lending.
75 million
in total across three platforms.
Yes.
Yeah. See, we don't have that support in the US, which would be a big deal just from a PR perspective to say that the government is supporting it so directly.
No, that's related to super PACs and the banking lobby actively controlling the government.
We can't open that can of worms, but yes, it could have something to do with it. Okay, so it seemed like at the AltFi conference, it was quite interesting to me to see how much interest there was in the Lending Club IPO from a bunch of British financial services guys, and you had your own slide on there, which
page 25.
Page 25. There we go. You talk about it. So I want to actually touch on TrustBuddy in a little bit because they actually are public. But
sure.
Firstly, let's just talk about the Lending Club IPO. And you came up with this interesting valuation of $6.2 billion that Lending Club may be valued at when they IPO. Can you explain how you came up with this relatively high number?
Well, we don't think it's particularly high, actually. If you look at where some of the tech companies in the US are trading, it doesn't seem that demanding, frankly. I mean, what we did is standard, one-on-one finance. We just took a discounted cash flow analysis. We're looking at the free cash flow that we think will come off Lending Club over the next 10, 20 years and discount it back. Now, the key question is, first of all, how quickly is Lending Club going to grow? And, we have our forecasts and, we can unpack those, but, we have it growing reasonably quickly, perhaps 50, 60% per annum, over the course of the next 10 years. And then we make some assumptions about how much operational leverage they have. So, how quickly the costs will grow. And, Once you have those assumptions, you can estimate what the free cash flow will be. And then the question is, at what rate do you discount those cash flows back to the present? Now, when we're raising money for TrustBuddy and Zopa, and, we're asking around, where are the VCs, looking at this in terms of the risk profile, we're hearing that people are actually using cost of equity as high as 30% to put money into some of these early stage privately held companies. To us, that feels far too high. Mm-hmm. So when we're doing a DCF, a lending club, we're using a cost of equity of 15%. And, our view is that when lending club is, well understood, and has already got a large free float on the stock market, we think the cost of equity will probably drop down to about 10%. But initially, 15% feels, there's enough risk premium in there to allow for this being a relatively young company. So but if you use a 15% cost of equity and our assumptions for revenues and costs, $6.2 billion just drops out of the model. And, that equates to probably something around, 25, 30 times 2014 revenues that we see for the business. And last valuation, as I'm sure you'll know, was 2.3 billion, I think, which is equivalent to about 12 times forward revenues. Yeah, so I think we've got a bet, don't we?
Yeah, we do have a bet.
It's going to be over 5 billion, and happy to double up on that if you want.
I think we'll keep it as it is for now, but it's because I continue to be surprised, so I may end up being surprised here as well. So are you finding, are you hearing from your UK investors interest in this IPO, or is this just something that you're putting together personally?
Well, it's interesting. So we did this All-Fi conference on Tuesday, and, our editor, publishing guys suggested we send the pack to all our investors. We sent it out yesterday morning, and we got, a very large number of hits. I think we got a record number of hits on the research note, multiples of what we get on any other research piece. So there's an immense amount of interest in this space. And what's interesting for us is, Karen is the analyst covering TrustBuddy, and TrustBuddy is the only listed peer-to-peer company in the world currently, and we think it's immensely cheap. I mean, it's trading on about 5 times 2014 revenues currently. That compares with the last valuation on TrustBuddy 12 times.
60% discount.
Say it again.
It's about a
60% discount to lending clubs valuation multiples. And if you do the same DCF calculation, you get it's worth about $500 million, and the current market cap is about 0.14 billion. So if our DCF analysis is correct, it's got roughly 3x upside.
Right. And so, can you just explain for people where is TrustBuddy, what are they, and how they operate?
Sure. Do you want to do that?
TrustBuddy's model is slightly different to Lending Club in that they have a payday model. So the loans are a 30-day loan for a standard 12% interest to the borrower. So a lender has roughly worked out as an average of a 13% yield annualized over the last number of years. The lender doesn't get charged any fees. Currently, TrustBuddy are operating in about 7 geographies on the borrower side and 11 on the lender side, including the US and the UK.
Okay.
So that the lender can decide which geography to lend into.
Yeah. And what's really interesting about TrustBuddy is that we're starting to see, I think in the US you already have a very large amount of institutional capital and not very much retail money, whereas in Europe it's the flip side. So we have a huge amount of retail money, and institutional money is just starting to learn and invest in the peer-to-peer space. For TrustBuddy, we have spoken to several people that are actively looking and working with their teams to put institutional capital onto the TrustBuddy platform. So you can get this huge gearing because they have a huge number of borrowers looking to borrow, and they have a lack of people, a lack of capital to lend to them. So as this institutional capital lands on the platform, you get this huge boost to the revenues. So we actually see the revenues growing 150% or something in 2014.
Yeah, volumes grew around 25% month on month into January, simply just because of the institutional capital that came onto the platform in January. So 12.3 million euros came on in January from the December transaction.
Right.
So.
But there's more capital coming in the second quarter. So, and if everything goes to plan, there will be multiples of that again. So we can see the revenue just growing exponentially, frankly, for several years.
Okay. Well, I should point out too that I don't really cover payday lending at Lend Academy, so
I know you frown on it.
I frown on it a little bit because I have some ethical issues with it, but I know that it's a public company and they are providing a service that is, they're doing very well.
It's in demand. I mean, my view is that, the more people that come into payday lending and compete in the space, the more the kind of the supernormal returns will shrink, and the better deal the guys who actually need money will get. So,
right. And that's a good thing. There needs to be. I mean, the whole the concept of payday lending is the thing that I worry about is it just leads to a debt spiral, which leads to bankruptcy, and that's not good.
Well,
for
a death spiral makes it sound like the guy is actually going to die, right?
No, debt spiral.
He just has to put his hand up and say, can't pay, won't pay, and just walk away, and he starts again.
Right. Okay, so one thing I just want to, you didn't really cover this, and I'm just curious about it. You talk about this Liberum alt-fi index, which is establishing a range of data on the UK peer-to-peer and alternative finance sector. Just explain what that is exactly.
Sure. So we've teamed up with a guy called David Stevenson, who I don't know if you've seen his columns, The Adventurous Investor in the Weekend FT. He's a very entrepreneurial journalist who got his own. He actually ran the alt-fi conference on Tuesday.
Right. Yep.
He's very interested in setting up a whole series of benchmarks so people can understand what's going on in UK and European peer-to-peer. So we already have some volume metrics on the alt-fi website where you can just see which platforms have done how much volume and how fast they're growing. But within the next couple of months, we intend to set up a whole range of metrics where you can actually measure and see what the net yields by cohort have been historically, and start to compare the returns you can get from different platforms. Because as it currently stands, it's actually really difficult to in a robust way evaluate how attractive it's been to put money onto the different platforms, because they all represent their performance in a different way, and as you can imagine, they all try to represent the data in a way that makes them look as good as possible. And frankly, some of them are growing so quickly that there's an ability for them to I would say conceal some of the less well-performing cohorts simply by virtue of the huge growth they're seeing.
Yeah. Okay. So are you covering just the big three in this index, like Zopa, Funding Circle, RateSetter, or who are you covering?
I think we'll cover everyone who we feel is material. I mean, so I don't. I think we probably have about 10 platforms on there currently. But as the sector grows, that can easily increase to pick a number. I mean, we don't have any. We're not going to set a threshold. That we're only going to look at the top 20 or 50. Right.
Right.
As big as the sector gets, we're happy to grow with it.
Yeah, it's one thing that's curious. I'm curious to get your take on, and that is there are so many platforms. The US seems to be lagging behind the UK in this department. Like at the alt-fi conference, there was a huge number of consumer platforms, peer to business platforms. I mean, some of them are very small and really getting going, and they're totally dwarfed by the big three. But it seems like there's certainly a very robust entrepreneurial environment here in this industry.
Yeah. I wonder if it's that in the US, as you were saying earlier, there's a huge number of individual banks, and there's probably quite a healthy, perhaps more efficient financial system in the US. I'm just speculating. Whereas in the UK, I think we have our big four or big five banks, not particularly competitive. We're just going through a financial crisis, so a lot of the smaller players have kind of shut down or been absorbed. So there probably, frankly, isn't as much competition over here. So there's probably a little more low-hanging fruit, and it's possibly more obviously an opportunity in the UK for peer-to-peer to get started. Given just simply less, a weaker value proposition from the existing incumbents.
Right. So do you, when you're looking at these companies, do you look at their underwriting models to see if you think that they're doing a good job, or is that sort of beyond the scope of your analysis?
No, I mean, Min is sitting beside me here, and we've built some huge Excel spreadsheets, and we have pretty fast computers here, and they've been falling over regularly while we've been crunching the data. I mean, what we did was we basically downloaded the entire loan book of Lending Club and Funding Circle and Prosper, and we put all the loans into different cohorts and actually just work out an IRR by goal seeking iteratively to find out what rate of interest actually just you get from each cohort. So, and that is the right way to do it. I mean, I think there are some blogs, I'm not sure if your blog does it, but certainly some blogs already doing that kind of IRR calculation by cohort to work out the net yields. And then we're also projecting expected losses for loans that haven't matured yet. So, you can kind of extrapolate the existing loss curves to get a sense where the loans will end up. Because as I'm sure you know, on day 2 of a loan, it's not going to fall over.
Right.
So if you've written, billions of loans yesterday, then your credit quality is going to look probably quite good relative to what it will ultimately become. So I think it's important to have a consistent methodology to really accurately measure the relative returns. And I think, frankly, that's one thing the regulator hasn't shown any indication of planning to do and really should do. So I think it's incumbent on the regulator to encourage a basis to make an apples to apples comparison of what risk and what returns you can expect to get from various platforms.
So how do you compare with the UK returns with the US returns? The US, obviously, you're talking to Zopa, RateSetter, and even Funding Circle, they're definitely their interest rates are lower.
Yeah, it's true.
Relative to the US.
It's a good point. I think, frankly, the US platforms have been willing to have a higher risk appetite. So they've been more willing to work with people that are consolidating their credit card debt, and they've been more willing to tolerate higher loan losses. And therefore, unsurprisingly, you take more risk, you get a better return. I think Prosper's done about 9.3 net yields over the last couple of years. And I think Lending Club's doing just slightly under 7%. So, you take more risk, you do get a better net yield. Whereas in the UK, Zopa and RateSetter, because they have had to build their businesses organically and establish trust slowly over time, I would say they've erred on the side of being too cautious.
Right.
So, I would comfortably tell widows and orphans to put their entire pensions into Zopa loans because, hell could freeze over and your Zopa loan losses might go up 10 basis points. Right. They're incredibly risk averse, and try it yourself. Apply for a loan on Zopa and see if you get accepted. They're really tough actually.
Right.
Which I find quite reassuring. So I wouldn't want to lend money on any platform that was willing to lend money to me. So.
Okay. So let's this final point here. I want to talk about this slide that you had that was this really interesting to me. You talked about how the P2P sector is like like the Walmart, Ryanair, which is the low cost airline over here. That's Walmart. We all know the story about Walmart and how they lowered the costs for a whole segment of retail. You're saying that the P2P sector has the potential to save the UK an estimated 2% of GDP per annum. So can you expand on that and how you kind of came up with that number?
Yeah, sure. So there's a whole bunch of research done by, again, this chap Thomas Philippon at NYU and also by a couple of guys at Harvard. And, we can get you links to those papers if you're interested. But basically, they've done work looking at the efficiency of different sectors, like, in the intermediation business, like wholesale trade or retail trade. They've looked at what percentage of their equipment spending has been IT. And unsurprisingly, people realize computers and internet were quite helpful in the intermediation businesses. They've invested more in IT, and sure enough, their efficiency has gone up. So their cost as a percentage of GDP. So the sector's revenue as a percentage of GDP has come down just because they've got more efficient. They've competed against each other, and they've made room in terms of the overall economy for other sectors to grow and develop and hire people, and that's healthy for the economy. Banks have done the opposite. They've invested in a lot of IT to, I would say, bamboozle everybody with science and, justify charging higher and higher fees and, taking all the value for themselves. And, it's grown like, I'd say grown like a weed, frankly. The revenues of the banking sector as a percentage of GDP have grown from, around 4.5% back in 1970 up to about 9%, around 2010. And, if you just do regression analysis versus other sectors, it looks like the financial sector should be able to operate at just about, say, 7% of GDP. So just by virtue of shrinking from 9% down to 7%, that frees up 2% of total GDP to be deployed elsewhere. And the way to think about that in real life, I think of, all those ATM or risk managers sitting in banks that could be, redeployed as teachers or nurses or doctors, what have you, adding value in the economy, that are kind of tied up, wasting their resources, kind of clogging up the financial system.
So you're a banking analyst that's pretty bearish on the banking sector, it sounds like.
Well, actually, I'm bullish on banks in the short term because I don't think anyone is going to really believe what I just said. I'm going to put it differently.
I'm sure Lend Academy listeners will agree.
Well, but the people who are investing in banks,
right.
The Fidelities, the BlackRocks, the large institutions, they're not ready for the story yet.
Right.
And, the banks are quite cheap. I mean, George Soros was just recently saying that, the banking sector in Europe is actually a bit depressed now because everyone's worried about the stress test the ECB is about to do. So in terms of just raw valuations, as long as the wheels don't come off the sector for 10 or 15 years, they actually are quite cheap. It's just, what we're talking about here, the peer-to-peer sector is very much a small acorn, and it won't grow into an oak tree for 10 or 15 years. So, and frankly, if you're the CEO of a bank, you don't really care if peer-to-peer kills the banks in 10 years' time because you'll have sailed off into the sunset, with all your bonus money and stock options and what have you. So there's a real agency problem that the banks have. And frankly, some of the investors, I think if you remember back in the dot-com days, people were talking about the end of bricks and mortar and worrying about online internet impacting the banks. And then, that was kind of topical for about 6 or 12 months. And then everyone stopped talking about it and the banks had a great run. So now I think, there's very little talk really in mainstream investment communities of this being an issue for banks. So I think we'll really need to get onto the front page of the FT or the Economist or whatever. And then maybe people start to actually say, okay, maybe we should all start worrying about this.
All right. Okay. Well said. Well, I appreciate your time. Thank you, Cormac. Thank you, Karen. Appreciate it. And we'll be very interested to see how this all develops. Thank you.
Thanks.
So there you have it. Fascinating stuff, in my opinion. Could have chatted with Cormac and his team for hours. What I found most poignant, really, the takeaway that I got from my interview with him was that the traditional banking system has really not improved very much. And here we have finally a way to make it more efficient. And Cormac has done a lot of work in quantifying that. And we have the numbers that he just mentioned that really get me excited. This is something that is going to be great for the economy. It's not going to be great for banks in the long run, but it's going to be great for consumers and great for the economy, where we'll have now a more efficient system and people can divert their resources elsewhere. So on that note, I will sign off, and we'll have another edition of the podcast coming up that I recorded on my trip to London with the leaders of the major platforms there. That's coming up again soon. I'll talk to you next time.